Hello, everybody. It's Tortoise Investing coming at you today with three more dividend stocks that you can buy and hold forever. All of these I feel are great compounders, and they are down off of their highs, and some of them are down quite a bit here in the last little bit. Now, before we dive into those, please hit that subscribe button. If you are new, hit the like button. Those two things help tremendously, so much, and I greatly appreciate everyone's support. Welcome to all the new subs. We're setting at 615 and rising every day, it seems, which is awesome. Let's get that march to 1,000. This quick disclaimer, none of this financial advice. Always do your own research before buying. So today, we're going to be taking a look at Home Depot, McDonald's, and PepsiCo. So Home Depot's last high was December 10th, 2021. And since then, it is down 29.73%. Year to date, it has had a drop here recently of about 12.3% from September 1st to now. I love Home Depot. I really like this company. It's got adjusted free cash flow yield of 5.44%. We got a dividend yield of 2.86%, a payout ratio right at 51%. All those are green check marks to me. Revenue's been rising at a rate of 9.3% over the last 5 years. Very nice. Free cash flow over the last 10 years has been rising at a rate of 7.34%, but since 2021 has been in a decline. I do think that this is temporary and something that's just going to get right back to where they need to. The last 2 years has been really tough. Homes are not really something a lot of people are looking into with interest rates being as high as they are. I feel that's brought the stock down some and it might be a great buying opportunity. EPS has been growing at a rate of 18% over the last 5-10 years. Just right in line, 18% average. Very nice. Debt, they have $41 billion. Their EBITDA is $27 billion. Typically, I don't like companies that have three times their EBITDA or more in debt. I do make an exception from time to time, with McDonald's being one of them. We'll look at that in just a second. But this isn't the case here, so not an issue. The dividend's been increasing at a rate of 18% over the last 10 years. And the last one coming in at 10%, so still great double-digit growth out of that dividend. That is some great compounding right there. And another thing that you get with this company is share buybacks. They have been buying back shares over the last 5 years at a rate of 2.8% a year. Look at that. That's the one thing you want to see dropping: debt and shares outstanding. That means you're getting a bigger and bigger piece of the pie. Return on capital employed is just silly. Even during COVID year, it's 48%. 2021's 28%. This thing has hovered anywhere from 30 to 50% since 2014. So very strong return on capital. Like it a lot. Next up, McDonald's. McDonald's is off of a recent high as of June 30th and has dropped around 16.79%. Another company that I like a lot. I read a thing, it hasn't been this cheap since COVID. So, I mean, again, do your own research and stuff, but might be a great buying opportunity. Adjusted free cash flow yield 3.57%, dividend yield 2.69%. Nice. Payout ratio 54.75%. So, take a look at the revenue. Kind of flat-ish over the last 5 years, but since 2020, I don't know. It's not been a growing all that much, but it is McDonald's. Moat and a half. Everyone knows the Golden Arches. These things are opening up all across the country. I think that this is going to get right back on track. Free cash flow has been increasing at a rate of 8% over the last 5 years. Very nice. So even though their revenue is kind of stagnant, they are still generating free cash flow. Very nice. The EPS has been increasing at a rate of 5.5% over the last 5 years, so that's also going up. Now their debt. McDonald's, your debt. You got $35.9 billion in debt. Your EBITDA is 9.74. This is like 3.5 times. Again, Usually that's a big red flag for me, but with McDonald's, I will make the exception. My personal opinion, as always, do your own research and stuff, but I think that it's just got such a ridiculous moat, and everyone loves McDonald's. Everyone goes to McDonald's. Um, it's something that's going to be around 60 years from now. The dividend's been increasing at a rate of 8% over the last 10 years. Here recently, they've been doing bigger and bigger hikes, which is awesome. 13.378% over the last 2 years. So as you see here, these are getting wider and wider, which is nice. Their last one came in a bit over 10%. And shares outstanding, they have been buying those back at a rate of 3% over the last 10 years. Over the last 5 years, 1.89%. So even though it has slowed down, hopefully it's going to be something they pick back up and start doing some more of, especially now that it's dropped. I would love to see them put that free cash flow to use. And the return on capital employed 2020 was 15.7. And besides that, this thing's been hovering around 20 to 30s area, it looks like. But yeah, I like it. I like it a lot. Next up, Pepsi. I drink Kickstarts like crazy, and yeah, it's a Pepsi product. I didn't know that until the other day. Pepsi is down, down off their recent high of 196 as of May 12th. They're down 18.4%. That is a lot. A lot for this company anyways. Big drop, super quick. Just free cash flow yield, 2.99%. It's got a dividend yield over 3% for Pepsi. That's ridiculous. And a payout ratio, 80%. A bit on the high side, but again, I feel like it's something that they're going to get under control. And they usually hover around the 70-ish area anyways, so I think it's just a temporary headwind. Again, inflation, rising prices and stuff is affecting pretty much everything across the board. But Pepsi continues to perform and perform well. They killed it with their earnings and actually raised their guidance for the year, which is just phenomenal. Revenue over the last 5 years been increasing at a rate of 6.34%. This is taking off like a rocket, and that's the reason I'm not worried about the payout ratio. I think that they are going to be perfectly fine. This is just going to keep growing. They have pricing power. They're able to increase their prices, and people still want to buy their stuff. Similar to McDonald's revenue, but this with their free cash flow, it's kind of been leveled out for the last 10 years, decreasing at a rate of 0.28%. Again, I see this being a temporary headwind. I like the direction the company's going in. They have so many products and so many food and drink items that people love. I just honestly think that this rates being higher for longer thing is just hurting a lot of these great high quality companies. EPS been rising at a rate of 13.69% over the last 5 years. Very nice. Up and to the right, their debt is $35.17 billion. Their EBITDA is 14.77. So that is in line with our 3-time rule. Again, I made an exception for McDonald's. Dividend's been increasing at a rate of 8% over the last 10 years. Their last one came in right at 10%, over 10%. So that is very nice. Again, just compounding away. Love it. Shares outstanding, not too much to talk about here. They've at a rate of 1.26% over the last 10 years, but here recently it's kind of flattened out. Again, similar situation with McDonald's. Maybe this is going to be something that they start doing again. Start buying back some of those shares now that you're hovering down here, dropping almost 20%. I would love to see that. And as far as their return on capital employed, 2020 was their lowest, 14.49%. But since 2013, it looks like they are hovering anywhere between 16 to 18% on their return on capital employed. So yeah, 3 great companies. I like all of these a lot. Again, do your own research and stuff before buying anything. I hope you enjoyed that. Again, hit that subscribe button and that like button for more. And until next time, see yous.